Good afternoon, everyone. Thank you so much for having the paper featured on the program. It's really an honor. So today I will speak about bank financing of global supply chains. This is work joint with Laura Alfaro, Masha Brussevich, and Andrea Presbitero. We are all with policy institutions, and so the usual disclaimer applies. So let me motivate this work, although I don't think much motivation is needed with our audience today. By starting from the observation that the last few years have seen a rise in trade tensions globally, geopolitical risks, and also a pandemic. And what we have seen around these events is an incredible shift in trade allocation patterns, something that has been dubbed in the international economics literature as the great reallocation of global supply chains. So what we show here on the right-hand side figure is US maritime import shares, the trade portfolio allocation of US imports by sea, which represent about 80% of global trade, so the vast majority, since 2018. So the shares are anchored at the end of 2017, and we see that as the US-China trade war in 2018-19 unfolds, there's an incredible reallocation of these import shares away from China and towards Asia outside China. So the blue line is China, the red line is Asia outside China. From now on, every time I say Asia, I will mean ex-China and the rest of the world. The China import share based on trade volumes declined by 30 percentage points in the first 4 years, or 5 years almost, since the start of the trade war. And so we see that US firms have relocated production and started changing the geography of their foreign goods sourcing. A lot of these firms are manufacturers. A lot of the goods they source from China and abroad serve as inputs in their production processes. So I want to make clear that most of what I'm going to be talking about refers to manufacturers and medium-sized retail and wholesale traders. We care about supply chain disruptions because they have important macroeconomic costs. The international economics literature estimates that about 0.5 percentage points of GDP growth was shaved off because of the tariffs imposed at that time. So we're going to use this opportunity, the 2018-19 tariffs, to learn about a particular response of firms to trade wars and in particular the rerouting or rejiggling of supply chains, the search for new foreign suppliers when a particular market on which they are very dependent is tariffed. So as a very quick refresher, the US-China trade tensions of 2018-19 unfolded with tariffs imposed by the US on more than 100 of its trading partners on the vast majority, on just an incredible amount of products. And China, which was the main import or source country, import source at that time for the US, was at the fore of the trade tensions. You may remember the first rounds of tariffs concerned solar panels and washing machines in February 2018, and then that was followed by steel and aluminum tariffs, and all of that was sort of ramped up later on in the summer of 2018. By the end of 2019, the average tariffs on Chinese imports had increased sixfold to levels that were pretty high historically, but they are sort of dwarfed by the ongoing trade war, which now in October 2018, we stand at an average tariff rate of about 18%. So I do want to say that some of those tariffs were continued and even kind of jacked up in the years after 2018-19. So the phenomenon I'm going to be talking about is sort of ongoing. So I'm going to have two ingredients that I want to bring together in motivating this work. There's going to be a trade ingredient and the banking ingredient. So let me spend 2 slides on each of these two pieces of the stories, and then I'm going to articulate a bit more sharply the research question and bring them together. So what we know from the trade literature is that supply chain relationships tend to be very sticky, and therefore reallocation is costly. If reallocation or setting up supplier relationships were not costly, we would see very diversified firms globally, but even some of the US multinationals are not particularly diversified. So finding new international or foreign suppliers tends to impose non-trivial search costs on importers, and these search costs give rise to very durable, sticky relationships. And one can map the complexity or degree of customizability or complexity of products to the stickiness of these trade relationships. In general, products that are simple, that are traded in spot markets or not particularly complex, are more easily substitutable, give rise to less sticky relationships, whereas highly customizable products, for instance, let's say, the customized doors of a sports luxury car, give rise to very, very durable relationships that are extremely difficult to replace. And so what we see in the data, and in fact this is a pattern over the last 20 years or so, is that US importers are undiversified. And by the way, this is against the backdrop of a fairly long run move away from China as real wages have increased in China. And so it's become a more expensive market. And US firms have been transitioning to lower cost markets in Asia, such as Vietnam and Bangladesh. Nevertheless, despite that trend, US importers in recent years are very undiversified. On the right-hand side here, we have a table where for every firm and the products it imports at a 6-digit level, we look first at the median and maximum number of source countries across products for a given firm, and then we report the median, 75th and 95th percentile of the number of source countries across the firms in the cross-section. And we see that the median firm in 2016, in 2022, and we have older estimates for 2007 for some of Paul Antrasch's work, suggesting that the median firm has only one source country, suppliers from one source country for a particular 6-digit product. And we see even the 75th percentile is still one, 95th percentile 3 source countries for a particular product. So, examples such as Apple that very easily come to mind. Oh, Apple is very diversified. If you Google it and you ask how many Asian suppliers does Apple have, now it's about 325. It used to be 5 years ago 360. And so people tend to think of multinationals as being extremely diversified, but they are in the far right tail of this distribution. The typical manufacturer, medium-sized manufacturer in the US, and by medium-sized I mean 10 times smaller than the typical public firm, listed firm in the US, would have only one source country. And so when that source country experiences tariffs, then there's an imperative to move away from it, or to at least diversify away. So we'll exploit the tariffs as a large input cost shock to US importers and ask how do firms respond by way of switching suppliers or looking for new suppliers, looking to diversify away from the tariffed market, and in particular China. And again, China is our focus because it received blanket tariffs pretty much, and it was the #1 source country for the US. And in answering this question, we'll also emphasize the role of financial constraints. The median US importer in our sample will be this mid-sized manufacturer or wholesale retail trader. It's a firm very reliant on bank loans. 40% of its liability will sit in bank debt. These firms have access to contingent liquidity lines of credit from banks, so they are not particularly financially constrained. The nature of the sample will work against us sort of finding anything. So now the banking part of the story is to look at the role of commercial banks in sort of lessening the reallocation. So here I want to emphasize that commercial banks will be very important in alleviating financial frictions, the way we think about it. Specialized banks, in particular, banks that interact very often with borrowers in particular industries or of a particular kind, such as trade-oriented firms, should be particularly well equipped to help their borrowers engage in switching supplies, rerouting or diversifying their supply chains. And by specialized banks, here we have a very precise definition in mind because of the nature of the question we ask. We're going to think of specialized banks as banks that supply certain services. And here we're thinking about trade finance, letters of credit, loan performance guarantees. So very, very specialized type of financial products that exporters and importers require. And these banks will also be specialized in working in Asia. So we argue that specialized banks will be critical on two fronts. They should be able to support importers through two channels. First, by supplying credit. And we'll see and we'll argue that they are able to supply credit at more favorable terms because they interact with borrowers in their areas of expertise a lot more. They received specialized signals about the borrower quality. They understand the business models of their borrowers better, and so they are able to outbid non-specialized banks in offering when they offer loans to these borrowers. But we also argue that they should be able to provide information as well. If specialized banks have offices across Asia, then they have access to local supplier information networks, and they can pass on information about those potential suppliers to their borrowers. So now I can articulate the research question as we want to ask if financial frictions affect trade dynamics. We want to understand this interplay, and then we want to zoom in on the role of banks in helping firms reconfigure supply chains after a large input cost shock. And then we want to also zoom in on the role of specialized banks in lessening financial and information frictions. And to give a preview of the results, we will find three main findings. First, that tariff hit importers affected by the war directly, the trade war directly, engage in significant supply chain realignment of input sourcing. This is not new. This has been shown in the international trade literature, but we'll show it in very granular firm product data to sort of have an anchor against which we'll look at the role of banks. Then tariff and surge costs are high, and tariff hit importers increase credit demand. I want to be very clear that it's going to be hard for us to distinguish between tariff-induced costs, the unit costs of trade being higher, and the costs of searching for new suppliers. Separating these two different components of the cost of operating in a higher tariff environment and reallocating supply chains, we will not be able to separate these two components. We'll talk about credit demand, the surge costs and tariff costs together as leading to credit demand going up. And then that specialized banks mitigate both financial and information frictions. And what we can do with our analysis is to put a number on the value of a relationship with a specialized bank. We will show that the time it takes to match to a new supplier, which is on average about 3 years, is cut down on average by 5.6 months if you are in such a relationship before the trade war. So let me dive right in. So by way of data, I want to emphasize two main data sources. We'll bring together the US credit registry with the universe of shipments to US ports. So we'll have firm supplier international shipment data from S&P Panjiva Supply Chain Intelligence, and we'll do a match on firm name and address to the bank firm loan level data from the credit registry. This match takes about a year and puts a lot of pressure on the research assistants who worked on this project. Once we have the match, which we are going to conduct very conservatively and retain in our sample only the firms that are matched precisely on name, we're ready to merge this with tariff data. And of course, the advantage is that we can conduct all of our empirics in a very granular fashion and sort of saturate with fixed effects and be careful about the claims we make empirically. So this is the industry classification of importers versus all other firms in the credit registry. The firms in the credit registry shown in red here, as you can see, they are tilted towards being manufacturers, wholesale traders, retail traders. They are in transportation and warehousing, so they have assets, fixed, tangible assets that they can pledge as collateral. By contrast, the importers tend to be even more concentrated in manufacturing and wholesale trade, and we'll carry out some robustness checks in the analysis. We'll drop wholesale traders, we'll drop multinationals, we'll drop public firms, all the sophisticated firms that may make it easy to find, may have ability to find foreign suppliers easier. We'll try to construct samples that are working against us, or sort of finding that are dampening our estimates, making it harder to pin down results. So the analysis will be a very standard diff in diff, and we'll have trade outcomes and lending outcomes. For trade, we'll look at supply chain participation, and we're going to relate supply chain reallocations measured by the probability of losing or gaining suppliers, the number of suppliers, and import shares. And then on the lending side, we'll look at credit line utilization as a very important yardstick of credit demand. Credit line utilization is the amount utilized out of the total revolver size that is available to you. And we know that credit line utilization cannot be denied by banks unless there's a good reason to be denied, which is that there's a breach of covenants. Otherwise, the bank faces legal risk. And banks will do anything to avoid that. And so it's a very, as clean as possible sort of measure of credit demand, because the firms just approach their banks and draw on their pre-committed existing credit lines. And we'll try to also give some information on the last channel, the information channel, some evidence at the end. Okay? So the tariff hit importers will be firms that are importing multiple products with at least one product hit by the trade war, meaning subject to tariffs. A firm with at least one product subject to tariffs will be a tariffed firm. And the specialized banks, like I mentioned, are the banks with specialized expertise in trade finance, with cross-border trade finance exposure to Asian borrowers. These banks are global US banks. They have exposures all over the world. And so to make sure we capture an Asia specialization, not a, say, European specialization, I'll show you placebo tests side by side to emphasize that the European specialization doesn't make a difference in reallocating supply chains in Asia. So standard diff in diff regressions after the trade war, 2018-19 versus 2016-17, and we stopped the sample to not run into COVID. All right, so I'm going to show you the results in 6 tables. The first 2 tables are about the trade sort of effects, supply chain reallocation. Then we're going to look at credit, and then we're going to bring them together. So the first piece of evidence reiterates what we know from the trade literature, that there was large supply chain realignment around the trade war. We see that tariff-hit firms were more likely to exit from China, to drop suppliers from China, meaning that we don't see shipments in a particular period from Chinese suppliers conditional on having observed those shipments per product for a given product previously. They are more likely to also reduce their import dependence on China. At the same time, the same firms are more likely to shift towards Asia. They increase the number of Asian suppliers, they're more likely to add new such suppliers, and they increase their dependence, their import shares on Asian markets. So this is at the firm product level. Let me now show you a little bit of evidence that these supplier search costs are material. So to do this, we're going to run some hazard regressions and look at the time it takes, the odds of finding a new Asian supplier, and exploit some firm heterogeneity and product heterogeneity to get at the notion that searching for new suppliers is costly. So what we see here is that the odds of finding a new Asian supplier are much higher for firms with low stickiness relationships, with low stickiness products, meaning with products that are simpler, less complex, less customizable, more substitutable. Those firms have a 16% higher chance of finding a new Asian supplier in the years after the trade war. At the same time, a firm with previous experience in Asia, maybe they were conducting business previously, prior to the trade war, on alternative products, those firms are 3 times more likely to find new Asian suppliers for a particular tariff-affected product. What about the demand for credit? So we find evidence that there's an increase in bank credit demand. So here we relate a number of lending outcomes, quantities, credit line utilizations, and interest rates on all loans, many of which are renegotiated every period, so that's where the variation comes from, and new loans, completely new loan originations. We see that tariff-hit firms draw their credit lines more. They increase the utilizations by about 71 basis points. And they also obtain they obtain a greater amount of loans at higher interest rates, by 4 basis points in the stock of loans and by 18 basis points on completely new loans. Credit lines are very important in the US context. 75% of all bank loans are credit lines. So we cannot say whether these credit line utilizations are used to build a new factory or to do something else. We don't have the goal of the utilization. So we think of them as, available liquidity for the firm to draw on whenever necessary. It may be just as little as sending teams of people to different Asian markets to find new suppliers, or it could be trying to set up new manufacturing facilities somewhere else, including in the US. We don't have data on domestic reallocation. Now, the 71 basis point is not huge, but it's not that small either. During the global financial crisis, during the COVID pandemic, we saw credit line utilizations rise by between 8 and 10 percentage points. So this is not even a percentage point, so to put that in perspective. Okay. What about the credit channel of specialized banks? So let's unpack this diff in diff coefficient I've just shown by whether the firm is working ex ante with a specialized or a non-specialized bank. And what we see, the credit line utilization goes up equally. If I have two credit lines from a specialized and a non-specialized bank and I need liquidity, I'm going to go and draw indiscriminately. These credit lines are available to me. They are pre-committed by the bank. I have no reason to favor one over the other. However, when it comes to lending, we see that other banks charge higher interest rates. And so this result is consistent with the notion that specialized banks, because they understand the business model of their borrowers, they have more access to sort of private information about them, are able to offer relatively better lending terms. And there's no such effect for the European specialized banks. So the conclusion is that specialized banks offer relatively advantageous terms on loans to tariff-hit firms, but all banks meet the increased liquidity demand as it shows up in credit line utilizations. So before I wrap up and I sort of bring together the trade and finance stories, I want to give you a little bit of evidence on the information channel of specialized banks. I've argued that these banks may not necessarily just help with credit, but also with information. And pinning down this channel is quite difficult empirically. You talk to bankers and bankers say, yes, we obviously talk to our firms and we know all the other bankers in the area and we make connections. The firms also attend trade fairs. They go to chambers of commerce. So there's an incredible flow between the business community and the banking community. Here I want to pin down this idea that if you were working with a specialized bank, you were more likely to match to a new foreign supplier than otherwise. And so we're going to go back to those hazard regressions and show that the odds of finding a new supplier in Asia, first of all, are higher by about 8%, 5 to 8%, if you were working indeed with such a bank. But interestingly, if that bank was locally present, meaning that it had offices in particular markets, let's say in Vietnam, that I am between 15, and I'm working with that bank, I'm between 15 and 17% more likely to match to a new supplier in Vietnam. And we stacked information for 6 destination countries, Vietnam, Bangladesh, South Korea, Japan, etc. And we showed that this is the case for each one of those markets. So this suggests that the banks know something about the local economy and they help you match to new suppliers faster if you're working with them. This is the same if we, instead of looking at banks' local presence through offices, if we measure it by whether they conduct syndicated lending to local borrowers or if they have local correspondent banking relationships. So there seems to be something in the data suggesting that there is an information flow occurring from the bank to the borrower, to the tariff-affected firm during the trade war that helps that firm reallocate faster. So finally, let me bring finance and trade together and ask, did the supply chain realignment towards Asia, was it faster if I had a relationship with a specialized bank? And so I'm going to take the diff in diff coefficients before tariffs hit times post during the trade war and ask, were they larger? Were those coefficients larger in the sense of supporting reallocation better if I worked with a specialized bank? And indeed, we see this to be the case. So the coefficients in the top row, first 3 columns, are larger than the ones in the lower columns, and they are either flipped or sort of not significantly different from each other for the European specialized banks. All right. So before concluding, I want to go back to the notion that we can put a number on the value of a relationship with specialized banks using this work. If we look in the data sort of unconditionally on whether you dropped or not Chinese suppliers to start with, and actually this gives me an opportunity to emphasize that the reallocation we talk about does not mean outright exit from China. Most firms retain their existing suppliers in China and also at the same time add new suppliers from Asia, so they diversify. Some exit completely, but there is a cost to exit. Again, anecdotal evidence tells us that it's very hard to re-enter the market once you have exited. So the average time it takes to match to a new supplier is 12 almost 12 quarters, 3 years. That time is cut down by 3 months if you work with a specialized bank, and it's cut down by 6 months almost if you work with a specialized bank in a particular market such as Vietnam, and that's where you want to add your new suppliers as well. So to conclude, I have tried to impress upon you that bank relationships are very important. They help mitigate financial frictions in the face of supply chain shocks, and therefore alleviate the potential macroeconomic shocks associated with, or costs associated with those shocks. The US importers remain very undiversified. In recent work that expands the cross-section in this paper, we see that the degree of diversification, although has improved somewhat, it still remains relatively low. And working with specialized banks, US global banks that have local presence abroad and offer specialized trade finance services is very important. It helps cut down the time it takes to reallocate supply chains. Thank you.
Thank you. Thanks a lot. Björn?
Yeah, thanks so much for inviting me to discuss this paper. And let me start by, I'm working at a central bank, so Deutsche Bundesbank, so of course the regular disclaimer applies. So let me first emphasize the most negative thing about the paper. It doesn't really include European firms and banks. So not looking at that by this, it is a wonderful paper. I really have to say it's a great paper. We can all learn a lot. And I think given the geopolitical times we're currently observing, we can learn a lot from that paper. So let me give you a brief summary, although I think Camelia has done a wonderful job in showing the results of her paper. So the paper looks at the trade tensions, which have started in 2018, and then evolved until today, basically, between the US and China. And they have just amazing data. And I think this makes a lot of the uniqueness also of the paper. They not only have firm bank data on lending, but they also have firm-to-firm data on trade relationships between the individual firms globally. And they have firm product data on tariffs and can investigate when there was a certain tariff on a given product and how the firm reacted with respect to that. What they find is, as Camelia has shown, they show that if you are tariff hit as an importer, then you are more likely to exit China and more likely to go to a different Asian country. And you obtain more credit, which is also more expensive. And if you have a specialized banks, then the US banks ease financial information frictions, and in that they provide cheaper loans, and also they have consulting business which they offer to their customers and obviously use their networks. So the paper gives us an extensive overview into what actually happens when there are tariffs in place or tariff introduced, and with respect to the importer-exporter relationships, and then how banks as financial intermediaries intermediate between the different parties. So it's a very nice example of financial intermediation, if you will. So the core values of the paper, as I already emphasized, it's the innovative data they are using. And I think the poor are ace, so they presumably had a lot of work in the back. It is amazing what is in there and how much hand matching it must have behind this. So they have the US import shipment records, so they have supply chain adjustments of firm supplier level, and they have bank firm credit data from the Y14 data. They look at the trade shock and what was the response with respect to supply chains. So they show that there is geographic diversification going on, what I think many of us would have expected when you have a tariff shock. But they also show and emphasize the surge frictions and the financial frictions firms are facing, given that these tariff shocks are introduced, and what firms then actually do, and how long it actually takes time to find new suppliers once you observe a shock, and that many firms also in Europe might still be in between of building up a new import-export relationship network given the economic conditions these days. And what I find personally very important is they also emphasize the role of banks, because they show that banks reduce informational frictions, but also credit frictions, because borrowers of specialized banks have certain advantages. So what I will focus today in my discussion is I will look at banks and emphasize banks and how they help in intermediating credit, but also what they do as an additional service, the classical banking, if you will, that it's banks and providing advice, and what that eventually means for the real outcomes of firms. And then potentially a bit more boring, I also have 2 technical comments, if I have time, on selection and a method. So the first one on banks and how they obtain credit. And you state that the tariff-hit firms increase their credit demand drawing on credit lines. What I didn't really understand, you have the data available, but you do not fully use it. You use the utilization ratio. And you use an assumption. You go back to Robertson Sufi and say like, well, banks do not normally renege on the denominator. So it must be the numerator. But looking through your results, what you actually show is in table A9, you see that the probability of default is actually going up, which goes against exactly the statement you make in your paper. So there is higher risk, which makes a lot of sense, I think. And then you show like the interest rate is going up. So just looking at these two results and looking at the types of banks, it might be that specialized banks just know what's going on when you have a geopolitical shock. And you know these firms will be able to cope with it, where the unspecialized banks do not really know what's going on. They assign a higher probability of default, cut back on pre-committed credit lines, maybe to some extent, and also charge more because of the higher credit risk. And I want you to dig deeper into this because you have it readily available. I mean, you can look at the changes in the committed amounts and the used amounts, and not just use the ratio. And I was looking hard. You currently just use the ratio. It is fishy, but you have the data, just do it. And you have so many appendix tables that wouldn't hurt also. And what you could also do for better identification, do the classical Quadjamian. Do a firm times time fixed effect and look at the differences between specialized banks and non-specialized banks within firm. You lose a lot of observations, and we know these firms are larger and special because they have more bank relationships, but still it would help you carve out and be like safe on the identification side. And it's easy to do. Also, what I would find very interesting is to look more at the dynamics. What happens in between? Now we have a tariff shock, and then you say it takes about 3 years before you have found a new supplier. So how much of the utilization ratio do you use, and when do you use it? Do you see changes in the revenues of the firms? And as you said in your presentation, you cannot really, but I would urge you to dig deeper. Why do they demand more credit? Is it because of the tariffs? Or is it because of you're searching for alternative suppliers, so you have high search costs and have lots of travel or, I don't know, like networking costs and the like? Or is it both? I would urge you to try to figure out what is driving the credit demand here. And for example, what could also be interesting, you compare the costs of staying with your Chinese supplier to the costs of switching to an alternative one where you say there's a lot of search costs, to just understand what are the search costs implied with it. So I think it's important for policy to distinguish between supply and demand, to understand what are the implications for financial stability, and then of course to show that firm borrowing, it's not just it's transition, but not growth. So my second comment is on banks providing advice, and I love the channel because it's wonderful. It's the classical bank you would imagine. I mean, the classical banking was like giving advice to the customers and intermediating between certain parties. And here, first, I would urge you to rule out mechanical effects. It might well be that at some point you have decided we go to Asia. Now China basically falls apart, so you shift your business just to the other Asian countries because you already have built some kind of network in certain regions. What I would urge you here is to look at the fee income and directly to the supplier switch it. Currently, it's just the specialized banks, and you don't really see that firms which take credit out or build a new supplier network in these countries also have work with the banks in these countries, and these banks have higher fee income. So link this more directly and show that the advisory services and the credit provisions are in the same jurisdiction. But I find it super interesting because it shows the complementary things banks do. And also the question is, could we also tackle these kind of things by informational platforms or fintech platforms to be prepared to some extent with respect to future geopolitical shocks? Looking at real outcomes, I think this is the most important factor for analyses, of course. There are a few open questions. So the first one, I think, is if the firms which actually diversified with bank support, do they also experience less negative effects? So you argue about the value of financial intermediation. So, well, then show it in the real effects for firms, that firms have less decline in sales, less decline in margins, or survive maybe longer. And then also look more at the differences of what determines the search cost. And here you could, again, look at firm level outcomes and sales, inventory, profitability, all the like, and see if these firms have positive real effects compared to the others. You could also emphasize the role of banks as in their role as shock absorbers. And then, of course, what determines search costs? And we all know it's product related, it's the number and the quality and the like. But what more is it? Is it the language? Where should you diversify in advance, if you will, as a firm? The jurisdictions or the kind of law written and all the like. So therefore, it's important to understand in ex ante diversification. Now that we know that there are certain geopolitical shocks out there, firms might look into how can we diversify better and earlier in what regards, and then also where is bank or financial intermediation most valuable. And that's presumably at the parts where the search costs are the highest. And very quickly on the technical stuff, and we can talk more about that later. The first thing is a bit of selection, because it doesn't really become clear in the paper when do firms partner up with the specialized banks. It might well be that you select into having a relationship with the specialized banks now that you have just seen the trade shock. And here you might show like how long do you have the relationship. And it's super important because we also know from the relationship literature, there's a hold-up problem. So if you have long relationships with your banks, you might be held up. So on the one hand, it's the insurance mechanism. On the other hand, it's a hold-up mechanism. And getting these both determined would be super interesting. And the last one, you have a diff in diff. Your treatment is basically the Chinese firms. Your control is the non-Chinese importers. Because almost every firm working with the Chinese firm is tariff hit. This is the one. And the control group, there's almost none of the firms having business with China. And there might be a reason why also prior to the tariff, I was doing business out of China or I was in China. And maybe you can give a bit more insights into this here. But as I said, so search frictions are emphasized. The role of financial institutions is emphasized. It's a great paper, and I strongly recommend to all of you to read it. And sorry for being a bit over time.
Thank you, Björn. It was a very good also discussion that actually anticipated most of the questions I would have had. So maybe I'll give first the floor to you, Camelia, to reply, then then we open a discussion. When opening a discussion, also for online participants, if you can please state your name and affiliation and pose the question. This will help also the online participant to identify and follow better. But please.
So thank you so much, Björn. So with your permission, I'm going to focus maybe on the bigger questions and leave for the break the technical ones. So I'm going to just refer to the question about whether our results hold in risk-adjusted terms, and they do. And I think the way we interpret them is that even after controlling for default risk increases for the tariffed firms, the specialized banks still assess them as more core to their business and offer them relatively more advantageous terms because they're able to extract signal from them, specialized signal or private signal that is not available to the non-specialist banks. But that's a good idea, and I also appreciate that you're pushing us to look at commitments and utilization separately to kind of buttress this evidence that the drawdowns are reflective of increased demand. And then the second question I want to just say something on is that you're pushing us to separate the costs between the cost of operating with higher tariff, the cost of searching, and there are other costs. During the first trade war, as in the ongoing one, there's an large rise in uncertainty. Firms respond to an increase in uncertainty by increasing inventories, pre-ordering, sort of trying to front-run maybe what they would expect to be other waves of tariffs. And so all of those costs are lumped together in our analysis. And I'm thinking now maybe we can bring some survey data or other evidence to bear on your question. So thank you.
Thanks a lot. Let me open the floor for a general discussion if there are any questions. Yeah, Philippine.
Thank you very much indeed. Very interesting paper. I'm Philippine Courtiman. I'm working with Carlo, monetary analysis. The question is where you find that the firms have less time to, it takes to them less time to find new supplier when they go to another Asian countries. And so if they have this special relationship with a specialized bank, is this really because of the advice and information they would get from on the local markets, local suppliers? Or is it because the fact of having the support of a bank is like a stamp which tells to your suppliers, this is a good firm, it has, you can be guaranteed that if it makes an order, it will pay for it.
Thanks. Enrico?
Enrico Sette, ECB. Thank you. It's a very interesting paper, very nice and insightful. I have 2 points, basically. So the first, I was wondering whether you can provide like a relative quantification of the of the support that banks provide through credit and through advisory activities. The second point relates to the results on credit. I mean, that's very interesting, but somehow credit utilization can also reflect like the need to cope with higher tariffs, higher costs, and so on. So I was wondering whether you can observe other products like letters of credit or like the guarantees that banks provide that can be very important when you need to open a new trading relationship. Thank you.
Thank you. Frederick?
Hello, Frederick Toscani, IMF. Yeah, thanks very much. Very interesting. I have a question on the kind of micro to macro link. So if I kind of leaving the banks aside, just the pure trade data. Now you show sort of it takes 3 years to find a new, on average, for the median or the mean to find a new supplier. Then when you showed the motivation chart, we saw very quick, nearly immediate adjustments that actually flattens out very quickly, no? But the microdata would suggest that the pattern should look quite different. So maybe, I don't know, very big firms do it right away and they account actually for the bulk of imports. So it's kind of a question for how it works together and how much these relationships of the smaller importers actually account for in the aggregate. Thanks.
And I think you have the last question from Caterina and then we'll give you the floor to reply.
Oh, perfect. Caterina Mendicino, ECB. Thank you very much for the very nice presentation. I was wondering if you have a few insights for us in terms of bank reactions to tariffs. And here, what I have in mind is more a credit supply story, if there is any potential for credit supply effects. Now, when you look at your outcome variables, you, of course, focus on credit lines. But I was wondering if you also have results in terms of what banks do in terms of their supply on term loans, for instance. And in particular, if there are spillovers to other type of firms, if banks more exposed to firms which experience tariffs reduce their credit supply to other type of customers.
Okay, thanks. Maybe
yeah.
give the floor to reply.
Thank you so much for this question. So to start with, Filippi, I think some of the information is that the bank guarantees the quality of the borrower, so as it probably talks to its customers and sort of markets, the borrower looking for a new supplier. It's something that's very hard to pin in the data, but it's probably why U.S. banks are making more money from advisory services. Again, even those advisory service income that we see in bank balance sheets, in the balance sheets of subsidiaries in Asia, is actually a mix of underwriting revenue, M&A advisory services, other kinds of advisory / consulting business. So all of this data is sort of dirty. It's very just broadly suggestive of the channel we have in mind, but I think that your question is very realistic of what's happening on the ground. And there's actually in the business media, there's a lot of claims that the trade wars have opened new business opportunities for US banks in Asia. And more generally abroad. To Enrico's question, can we quantify the relative effects of the credit support versus the advisory support? Very difficult question, and mostly because our estimates are so different, they come from different data structures, but that's something to think more about. And we should look at trade finance directly. There is trade finance provided by stress tested banks in the credit registry. This market is extremely concentrated, so most of it is just given by 4 or 5 banks, but definitely something to look at. I think that's a great idea. It takes 3 years to match to a new supplier. So when I talked to business leaders in Georgia and Florida, I was told that that's sort of unrealistic. 3 years it takes to build a new factory. If you just want another supplier, at most 6 months. And so I think that reaction is very normal. I think we need to keep in mind the backdrop of this first trade war, which is that there was a lot of uncertainty. Will these tariffs continue under the next administration? Will they be rolled back? They were also smaller in size compared to what we see now. They were maybe not as broad-based as today. And so it's possible that a lot of firms did not look for alternative suppliers to start with. They waited. And so this 3 years is maybe an overestimate. The 3 years is also based on an analysis that takes us all the way to 2022, well into the pandemic. We have the zero COVID policy in China. We have a lot of lockdowns. Business is slow in some parts of the world. So all of these things are kind of working against being able to switch very quickly. Early versus late switchers, excellent question. I do expect that the larger, less constrained firms with cash on hand were able to switch faster, but that's something we can look at carefully in the data and maybe shed light on that question. And finally, Katerina, on bank reactions to tariffs, absolutely, there are credit supply effects. So first, in our paper, and I think the whole trade finance agenda that focuses on these trade wars should keep in mind that the US banking system goes into these shocks very well capitalized on the back of 15 years of financial re-regulation. Balance sheets are very strong. And in fact, in the first trade war, US banks did not receive a balance sheet shock. There's recent evidence from Italy that banks with firms exposed to the China import shock had large losses in their balance sheets, and they cut lending, and there was reallocation of lending to healthy, non-affected firms. None of that happened in the US. The banking sector is in a very different position to absorb this kind of shock. So that's one thing to keep in mind. Nevertheless, there is some evidence from other prior work I have conducted that the trade uncertainty, the policy uncertainty associated with the trade war, there's a second moment effect after controlling for the first moment effect, which is the tariffs themselves, that pushed banks to be more cautious with their credit allocation. We find no evidence of reallocation across sectors. The trade uncertainty was so pervasive across sectors, and it was so difficult to discern in the beginning who are going to be the winners and the losers, so to speak, from the trade war. So it's broad-based credit contraction, not very large quantitatively, but we see the banks being more cautious with their C&I lending and reallocate some of their balance sheet capacity to safe assets, in particular securities, during 2018-19.
Okay, let me thank again Camelia and Björn. Great paper and discussion.